Like learning about under-the-radar businesses, does a market-beating yield, a double-digit dividend growth rate, and a balance sheet devoid of any long-term debt sound good to you? Looking for a good deal on a great dividend growth stock? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. And make sure to stay tuned until the end of the video for a special news announcement. I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is a leading firm in the heavily fragmented HR space. There are so many boring but beautiful business models out there. I'm talking about businesses that cater to seemingly dull niches but make surprisingly large amounts of money in doing so. Want a good example? How about HR? Yup, human resources. Because humans need jobs and money, and jobs need people. This company connects the two. In the process of doing so, it's able to relentlessly increase its revenue, profit, and dividend. I personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. By the way, I explain exactly how I achieved financial freedom in just 6 years in my early retirement blueprint. If you're interested, you can download a free copy of my early retirement blueprint using the link in the description of this video. Getting back to the stock I'll tell you about today though, perhaps best of all, it looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of Robert Half International Inc., which appear to be trading at a significant discount today. Robert Half International Inc., stock ticker RHI, is a global staffing and consulting company. Founded in 1948, Robert Half is now an $8 billion HR leader that employs over 16,000 people. The company reports results across 3 different business segments: contract talent solutions, 63% of fiscal year 2022 revenue, Protiviti, 28%, and permanent placement talent solutions, 9%. Approximately 80% of the company's revenue is generated in the US, while the remaining 20% is internationally derived. Morningstar glowingly describes the firm like this, and I quote, "Robert Half should remain one of the leading global staffing firms in a highly fragmented industry. The company places skilled professionals in accounting, finance, and IT roles. We think its hold on small to mid-sized businesses, or SMBs, will persist, given its ability to fill open roles quickly and these SMBs' willingness to sign exclusive contracts. We believe this will yield greater profitability for Robert Half despite operating in a highly cyclical industry," unquote. While certain well-known companies get an outsized amount of attention from the investing community, there are a number of truly terrific companies out there that fly way under the radar. Robert Half is definitely in the latter camp, but I think that's a good thing. Some of my best investments over the last decade or so have been with businesses that don't show up across headlines very often. Providing talent and consulting solutions is an effective, high-margin method for making a lot of money. It's also effective for building a long-standing track record for rewarding shareholders with safe, growing dividends. Indeed, Robert Half has increased its dividend for 20 consecutive years. This stretches right through the GFC and the pandemic, which is impressive reliability. It puts them only 5 years away from the coveted 25-year mark that would mark a dividend aristocrat. The 10-year dividend growth rate of 11.1% is strong. There's been impressive reliability here too, and the most recent dividend raise came in at 11.6%. You're pairing this consistent double-digit dividend growth with the stock's market-beating 2.5% yield. That yield, by the way, is 60 basis points higher than its own 5-year average, and the payout ratio is only 31.8%, which shows us a healthy, well-covered dividend. I like dividend growth stocks in what I refer to as the sweet spot. That's a yield of between 2.5% and 3.5% paired with a high single-digit or higher dividend growth rate. The yield is on the lower end of its threshold, but the double-digit dividend growth rate is quite a bit higher than I'd usually look for. I really like these dividend metrics. Looking at business growth, Robert Half extended its revenue from $4.2 billion in fiscal year 2013 to $7.2 billion in fiscal year 2022. That's a compound annual growth rate of 6.2%. Solid. I like to see mid-single digit top-line growth from a fairly mature business, and Robert Half more than delivered. Meanwhile, earnings per share grew from $1.83 to $6.03 over this period, which is a compound annual growth rate of 14.2%. Outstanding. We can see that double-digit EPS growth is what has been powering double-digit dividend growth. A combination of prolific share buybacks and margin expansion have combined to drive a lot of excess bottom line growth. For perspective on the former, the outstanding share count has been reduced by 21% over the last decade. Looking forward, CFRA projects that Robert Half will compound its earnings per share at an annual rate of 8% over the next 3 years. This would represent a fairly substantial drop in growth relative to what Robert Half has done over the last 10 years. I commend CFRA for taking a cautious view, but I'd also point out that a high single-digit bottom line growth rate is enough to deliver satisfactory returns. I think some caution is warranted as we are entering a very uncertain period as it pertains to the overall economy in general and employment in particular. Employment demand will obviously have a direct impact on Robert Half. CFRA speaks to this point, arguing that some of the concerns are overblown, and I quote, "Despite escalating fears of recession, U.S. unemployment fell to a near record low of 3.4% in January, declining for the third month in a row. Further, U.S. job openings were at 11 million in December, an incredible 57% above pre-pandemic levels, signaling healthy hiring and wage growth will continue in 2023 and 2024 in our view." In addition to this favorable backdrop for Robert Half's staffing business, 73% of sales, we expect strong growth from its unique integration of staffing with the Protiviti Consulting Unit, 27%, unquote. CFRA sees an advantage over peers for Robert Half in the sense that it can combine consulting solutions with staffing solutions, adding value to both sides of the house and driving market share gains. If we take CFRA's forecast as the near-term base case for EPS growth, I think we're easily looking at similar dividend growth. The low payout ratio could even expand a bit and allow for dividend growth to slightly outpace EPS growth, but I wouldn't at all mind a dividend growth track that mirrors earnings per share growth. And when you're able to start off with a 2.5% yield, a high single-digit dividend growth rate can get you to a 10% plus annualized total return in a hurry. Moreover, Robert Half could very well get back to its double-digit growth ways in short order once we're through this economic uncertainty, which could propel even better returns over the longer run. This is a very compelling setup, in my view. Moving over to the balance sheet, Robert Half has a sterling financial position. The company has no long-term debt. In an environment where rates are rising and liquidity is draining, Robert Half is in a very favorable spot. Moreover, whereas a lot of companies have been gorging on debt over the last decade, Robert Half ended fiscal year 2022 with a cash position that was more than twice as large as it was 10 years ago. Profitability is robust. Over the last 5 years, the firm has average annual net margin of 7.6% and annual return on equity of 38.3%. Circling back around to the margin expansion story that I touched on earlier, Robert Half's net margin was routinely in the 6% area in the first half of the last 10-year period. This business is quietly making a lot of money and generously rewarding shareholders. And with brand strength, a network effect, entrenched relationships, and a built-up database, the company does benefit from durable competitive advantages. Of course, there are risks to consider. Regulation, litigation, and competition are omnipresent risks in every industry. Robert Half is highly exposed to economic cycles as a healthy economy supports demand for workers and hiring activity. There are limited barriers to entry in the industry. Broad changes in work and/or the workforce could impact the industry and company. Less outsourcing of HR needs would have a negative effect on Robert Half. Overall, I see the risks here as limited and acceptable, especially when lined up against the growth and quality of the business. And then there's the valuation, which looks appealing after a 37% drop in the stock's price from its 52-week high. The stock is trading hands for a price-earnings ratio of 12.8. That's very inexpensive relative to the broader market. It's also well off of the stock's own 5-year average price-earnings ratio of 19.4. The price-to-cash flow ratio of 12.3 is also showing a disconnect in comparison to its own 5-year average of 15.6, and the yield, as noted earlier, is significantly higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 8%. This dividend growth rate projection is at the high end of what I allow for, but I think Robert Half deserves the benefit of the doubt. The company has demonstrated an ability to grow the dividend at a double-digit rate for a very long time, and that's been supported by double-digit EPS growth for a very long time. The near-term forecast for earnings per share growth is the same 8%, which should allow for at least that much dividend growth over the foreseeable future. Also, the low payout ratio opens up a lot of flexibility, plus the company's balance sheet is as good as it gets, and that offers even more flexibility. This is a terrific business, and I do think it'll continue to reward shareholders with generous dividend raises. The dividend discount model analysis gives me a fair value of $103.68. The reason I use the dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since a dollar tomorrow is not worth the same amount as a dollar today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates RHI as a 4-star stock with a fair value estimate of $95. CFRA rates RHI as a 5-star strong buy with a 12-month target price of $101. I came out closer to where CFRA is at, although we're all in rough agreement here around that $100 level. Averaging the three numbers out gives us a final valuation of $99.89, which would indicate the stock is possibly 23% undervalued. Here's the bottom line, guys. Robert Half International Inc. is a debt-free, high-quality business. It's hard to find fault anywhere. With a market-beating yield, a double-digit dividend growth rate, a low payout ratio, 20 consecutive years of dividend increases, and the potential that shares are 23% undervalued, this under-the-radar name is a prime candidate for serious long-term dividend growth investors. And now for a special news announcement. Lockheed Martin Corp., stock ticker LMT, keeps racking them up. Over just the last 3 days, as I shoot this video, Lockheed Martin has scored 5 contracts or contract modifications. That's more than 1 a day. Sheesh. These add up to $1.2 billion in new business. We last highlighted Lockheed Martin as a high-quality, undervalued idea back in August when the stock was available for just over $400. It has gone on a run since then, but if there's any pullback, strongly consider jumping on this world-class defense contractor. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also, take a look at the description box below for some important links, including the link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I made my portfolio entirely accessible over at Patreon, and I also post alerts there whenever I buy or sell stock. I put my money where my mouth is, and I'm often invested in the same high quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who've been profiting from many same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.